Did you know that if you're married and your spouse does not work, you can still make 2 IRA contributions for the year? That's right, one for you and one for your spouse. It's called a Spousal IRA, and that's what this video is about. I'm Dan Lohmar, CFP professional and registered life planner with United Wealth Management, where we specialize in PRAP management and financial planning for pilots at United Airlines. And like many of you, my business partner, Alan Bewley and I are both pilots for United. Welcome to my video about spousal IRAs. Before we get going, if you want to learn how to manage your taxes and grow your money so that you enjoy the retirement you deserve and help your money last longer, then go ahead and subscribe now and hit the bell icon so that you know when new videos come out. How's it going, everyone? Hey, spousal IRAs, that's what we're talking about today, and I'm also going to talk about how to do the backdoor Roth IRA with the spousal IRA concept. I'll leave that towards the end. So right now we're just covering the basics of spousal IRAs. Hey, this is for educational purposes only. Please don't take this as tax, legal, or investment advice. Seek guidance from your own advisor or your own personal wisdom for your particular situation. Why is this important to know? Well, it's just another way to save tax-deferred money or tax-free money for retirement. And if you're the person contributing, you may just think of it as a way of doubling your IRA contributions for you and your spouse. And then if you're a person that is concerned about having RHA spillover and you're kind of holding back on your PRAP contributions, this is just another avenue to save for retirement and kind of avoid the possibility of having unnecessary RHA spillover. What is a spousal IRA? So normally a person has to have earned income to be able to contribute to an IRA, where the IRS made an exception to that rule, which allows non-working spouses to be able to save for their own retirement nest egg. So that's basically what it is. It's just a rule that allows money to go into a non-working spouse's IRA because they don't have earned income. So, but if you're the person contributing, again, you might just think of this as a way to double your IRA contributions for you and your spouse. What type of IRA can it be? It's either a traditional or a Roth IRA. There's no IRA that is designated as a spousal IRA. The spousal IRA concept is just an exception to the rule. So knowing that you can have a traditional or a Roth IRA also opens up the possibility of doing backdoor Roth IRAs with these. And I say there's no specially designated spousal IRA. The reason I say that is because I kept referring to these things called the spousal IRA, but all this is really is a concept. It's an exception to the rule. So who owns it? It's titled in the name of the non-working spouse. It's not a joint account, so if you're the person contributing, just know that you are giving up the legal ownership of that money. So if that is a concern, just keep that in mind. How are you eligible for doing this? You must be married. You must be filing a joint tax return. You must have earned income that's greater than your contribution amount. For most United pilots, that is not a factor. And then there's no age restrictions on it anymore. I'll just make a side note about that, though. With the passing of the Secure Act, they got rid of the age restrictions. But if you're making deductible contributions past age 70 and a half, it can affect qualified charitable distributions. I'm not going to go into great detail on that, but just know that is out there if you're making qualified charitable distributions. And then also contributions must be made in cash. So how do you do it? Basically just open up an IRA in the name of the non-working spouse. You can also use an existing traditional IRA that is already out there. That's existing traditional or Roth IRA, whatever it may be in your situation. And if you're going to do a backdoor Roth IRA doing this, you'd want to have 2 accounts, a traditional and a Roth IRA. There are some income limits to it, so this applies to the deductibility of making traditional IRA contributions. And then, so those are the income limits. Most United pilots are going to be above these income limits, which disallows the ability to make deductible IRA contributions. But no matter what your income is, everyone is allowed to make non-deductible contributions into a traditional IRA. There's also income limits that apply to making direct contributions to a Roth IRA. And some United pilots are going to be above this income amount. Some will not be above that income amount. So take a look at these for yourself and see if they apply to you. But even if you're above these things, we're going to talk about the concept of doing a backdoor Roth IRA using these spousal IRAs. How much can you contribute? 2019 and 2020 contribution amounts are the same. So $6,000 if you're under 50, or $12,000 per couple, and $7,000 if you're over 50, or up to $14,000 per couple. And of course, each amount is determined by the account owner's age at the end of the year. The deadline for opening and funding accounts is the tax filing deadline for the year that you're going to make the contribution for. So it's January 2020 right now, and if you could still make a 2019 contribution up to April 15th of this year of 2020. And that applies to every year. Every year you have up until the tax filing deadline of the previous year to be able to make those IRA contributions. And then if you do that, what I would do is I'd write a note on the check or just provide some documentation that tells the custodian what year to apply those contributions to. Otherwise, they just assume it is for the year that they receive the check. That's kind of the big picture of the whole spousal IRA concept. Now, I want to talk about doing the backdoor Roth IRAs with this because most United pilots, again, are going to be above these income limits and not allow deductible traditional IRA contributions. So in my last video, I covered doing these backdoor Roth IRAs in pretty good detail, but let's just talk about a few things when it comes to doing them under the spousal IRA concept. So again, if you're above the modified adjusted gross income limits for traditional or Roth IRAs, this would be when this would count. So what you're going to do is make a non-deductible contribution into the non-working spouse's traditional IRA, and then basically just convert that or transfer that money into a Roth IRA. And essentially that is the essence of doing a backdoor Roth IRA. Now there are some other considerations. One, if there's any gains on the contribution before you make the transfer, those gains are taxable. And also the aggregation rule still applies to doing backdoor Roth IRAs for Roth accounts. So if a non-working spouse has traditional IRAs out there that have gains or have pre-tax money in them and they do a Roth conversion, there's going to be taxes owed on that conversion proportionally. And again, I talked about that in pretty good detail on my last video. Here's just kind of a quick summary of what that looks like. If you didn't see that, you're going to make post-tax contributions, the non-working spouse's traditional IRA. You want to do this Roth conversion. And if there's another existing traditional IRA out there that has pre-tax money in it or gains, you're going to owe money on this conversion proportionally. And again, this traditional IRA might be something that's in existence. It could be like a former employer's 401k that was rolled into an IRA. So possible workarounds to the aggregation rule when looking at doing backdoor Roth IRAs for the spouse. So things to think about is, does the non-working spouse still have a 401k at a former employer? Does that former employee's plan still allow traditional IRAs to be rolled back into it? Because the aggregation rule does not apply to 401k investments. So that's just something to think about. It's going to be completely up to that employer's plan to allow those rollovers in there if you're not employed there. So that's just something to keep in mind there. The other thing is too, is the non-working spouse going to be employed in the future? Is there a potential future 401k you could roll traditional IRAs into? And again, they wouldn't be a non-working spouse at that point, but that's just something to keep in mind if you're kind of thinking about the future and what you might be able to do with a large traditional IRA to avoid this rule. And the other thing to consider is the non-working spouse considering being self-employed. You could potentially set up a solo 401k and roll traditional IRA assets into that solo 401k. If you're going to do this, I would definitely seek the guidance of a CPA or someone who knows the details of setting up a solo 401k just so it is legitimate. And the other thing to keep in mind is you might just convert the entire traditional IRA if it's not that big and pay taxes on it, and that just frees it up for future years. Hey, that's it. Short subject today, and if you got questions, comments, recommendations, or referrals, be glad to hear them. Shoot me an email, dan@unitedwealthmanagement.com. There's also a contact me link in YouTube. I absolutely appreciate everybody's feedback I've been getting on these videos. If you fly with somebody or this is just not your personal cup of tea to deal with the financial stuff or the investment stuff like that, hey, just keep me in mind. I am open for business. The other thing I would love to do is connect with me on LinkedIn. I'd love to know who's out there watching the videos and just continue building our mutual network on LinkedIn. If you like this video, give me a thumbs up and remember to subscribe and hit the bell icon so that you know when new videos come out.